Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. This is part 9 of a series of videos I've done where I'm taking a look at what I would call attractively valued or apparently attractively valued stocks in each of the sectors as provided by FactSet Research. And this is part 9 where I covered the finance sector. Now, so far I have found more value in this sector than any other sector. In fact, I found more value in the finance sector than I have in any of the sectors that I've already covered or will be covering. As I pointed out in the written portion, there are over 131 companies that appear to be reasonably valued. Now with this video, I'm going to simply show one company from each of the 14 subsectors that are located in the broader finance sector. And I'm going to start out here with Aflac. And just to kind of familiarize those of you who aren't familiar with FastGraphs, the orange line plots earnings per share, and it represents a theoretical value for most companies. Now, in the finance sector, and I'm going to use Aflac specifically here, as I go through this, you'll notice a lot of companies in the finance sector trade at a discount to this orange line, and Aflac is no exception. Aflac has traded somewhere around a 10 PE ratio, normally, at least since the Great Recession. Now, prior to that, because I do want to point that out, Aflac used to trade at a premium valuation because it had a very excellent record. Coming out of the recession, their record's been a little sketchier, but I do want you to notice a continuous kind of reversion to the mean here. You know, the bottom line PE ratio was 4 times earnings at the throes of the Great Recession. And then they got up into the 9 PE, and they've held this 9 PE ratio, 9 or 10. And again, those numbers are ish, and you can see that that's been the norm here. On that basis, this stock might be a little overvalued, but nevertheless, it's attractively valued relative to a more normal 15 PE ratio you see with most companies. Now, the next subsector that I'm going to cover here, and I'm going to go through these quickly. I'm just trying to give you really a look at diversity here, at how diverse these companies are. So here we're looking at a property and casualty insurance company, Allstate. You know, you're in good hands with Allstate. Now, a couple of things that are interesting about this graph. I want you to notice that price tracks earnings as it has. Once again, we see a 15 theoretical fair value PE, which is the orange line. We see a normal PE in the 10 or 12 range. As I change this, I want you to notice that this changes. So here we've got an 11 PE. If I shorten that time frame again, we're back to 12. So somewhere between a 10 and 12 PE is normal for this company. Allstate currently trades at 11.4 times earnings, offers a 2.1% dividend yield. It's A- rated, which is good. And we're not showing debt on many of these financial companies because debt actually turns out to be the product. So anyway, there's Allstate. You can see that it's a moderately cyclical company. It did participate apparently in the financial debacle that instigated the Great Recession. They did cut their dividend in 2009, but since that time, they've had a very good dividend record. Their dividend increases have averaged just under 10% a year since 2010. So they're back on the right track, apparently, and it looks like a reasonably priced stock in the property and casualty insurance company. Now, next, I'd like to go ahead and move on. I'm doing these in alphabetical order, by the way. Alphabetical order by stock symbol, not by sector. These are investment bankers / brokers. Here we have Ameriprise Financial. If you look at the relationship between earnings and price, you can see that it's followed its earnings very nicely. You can also see undervalued moves always back into fair value, and you know, the stock has never really been overvalued during this time frame, which I think is a plus. This would be, as it has been historically, I think a really good time to be taking a position in Ameriprise. It has a 2.8% yield, trades at less than 9 times blended PE. It's A-rated with 44% debt to capital. It is forecast to grow at about 10.5%. It's followed by about a dozen analysts or so. If we go to the normal multiple, you know, I'm using 14 here. I can pick one of these lower multiples. I'll pick 12.9, which is kind of in the range. You can see that it offers the potential for some very strong rates of return going forward. It has a decent analyst scorecard. So anyway, there's Ameriprise Financial. As I go down through these, the next company I'm going to take a look at is American Express. And it's considered a financial conglomerate. And you see a very interesting earnings and price relationship. One thing I want to hope you're getting across here when I'm showing you these graphs is by looking at these long-term graphs, you can really see how the business has historically performed as a business, but you can also see how the market values that. And again, you see periods of misappraisal where the market undervalues a stock and overvalues it. We had a bad year of earnings here and some flatness. They got the PE down to about 10. That would have been obviously an excellent time to buy American Express. This stock tends to sell more at a premium PE ratio over this time frame than it does the basic. But again, if I shorten the time frame, that changes. And once again, since coming out of the Great Recession, which I think is true of a lot of financials, you start to see that that sells at a modest discount to what would theoretically be a fair value PE of 15. So somewhere between 14 and 15 times earnings is attractive for this particular company. Trades at a blended PE of 13.7, offers a 1.4% dividend yield. It's BBB plus rated and has 56% debt to capital. The next company I'm going to cover in the broad finance sector is Blackrock. It's an investment manager, one of the largest and most productive in the world. Once again, you see a very strong earnings and price relationship. They started paying a dividend in 2003, and you can see they've increased that dividend nicely over time. If you look at their growth of dividend, it's grown an average of about 19 to 20% a year, but there have been years where they've really increased their dividend substantially, as you can see. The stock is currently undervalued. It normally trades at a premium PE, but again, if I shorten the time frame, it's an 18 multiple company. It does move back into a 15 multiple quite often. It was pretty overvalued in 2018. It's now attractive. It is expected to have a down year this year, which I think caused this original, reversion to the mean here. Forecasting is moderate. Again, a down year this year of about 2%, but then we're looking at double-digit growth again going forward. So a long-term investment in Blackrock could be very fruitful, offers a 3% yield with good growth, as I mentioned. It's AA rated, and it has about 11% debt to capital, so I think that's reasonably attractive. Now, next I'm going to go into major banks, and the only one that I covered in the article was the Canadian bank, the Bank of Nova Scotia. And I want to show this, because the Canadian banks really did a lot better. Now, I could use almost any of the big 4 or 5 Canadian banks, and they would all look similar. They're trading at nice discounts to their normal valuations, offering almost a 5% yield. A-plus rated company. And I am going to throw a little bonus in here. I'm going to take a look at a Bank America or a Citigroup, which are major banks. I'm going to use Bank America here, which is a major bank, and of course in America. And I do want you to see what happened. They were generating unbelievable returns as they were taking advantage of some of the financial rules that existed at the time. But then they got greedy and they started messing around with collateralized mortgage obligations and collateralized debt obligations, CDMOs and CDOs. They even squared them and leveraged them. And then of course they went through this big financial collapse. But I kind of alluded to in the article, since that has basically been over with, they seem to be back on the track of growth again. So major banks in the U.S. especially have gone through some real issues. The next cover I'm going to cover is a company that's in the insurance and brokerage services company. This is a relatively young company, NStar Group. I've got to shorten the graph here to get a viable graph on this stock. It's an insurance broker. It pays no dividend, trades at around 11 times earnings. It's got a decent growth record with some cyclicality. Forecast growth is relatively flat. There's not a lot of expectation for growth, but this is one I'm showing you this stock not because I think it's cheap or a great buy, as much as because I think it's a very interesting example of how different companies can be even within the similar sector. Although this is insurance and brokerage services, it's a mid cap, it's a small cap, $3.5 billion, only has 9% debt, and it's BBB rated. So I just thought this would be an interesting one to look at. The next company I'm going to look at is a specialty insurer, First American Financial. I think this is a pretty interesting company, relatively young as a public company since 2010. Their dividend record is quite nice. They've grown their dividend dramatically. They do get periods where they grow it a lot or they increase it a lot versus times when they don't. It kind of ties into their growth. The stock is undervalued today, offers a 3.3% dividend yield. It's a BBB minus company with only 13% debt to capital. So if you're looking for decent income and some opportunity to get a good return through reversion to the mean, you might look at this stock. It goes back to a 14 or 15 PE. Rates of return are very nice. If it goes to its normal 14.5, it's 40% return by the end of this year and an annualized return of over 21% out over the next year and a half or two, if you will. The next company I'm going to cover in this particular group is Hartford, a multi-line insurance company. And Hartford is very interesting. They participated in some of the financial debacle, but as I mentioned, since coming out of the financial debacle, their numbers have been decent. They've a little bit of cyclicality, but they've been growing, trades at around 11 times earnings, which is quite normal for this stock. Notice it more or less more than often trades in the blue line. It has growth, historical growth of 6.8%. It's forecast to grow a lot faster than that over the next couple of years, and the longer term growth rate is expected to be about 12% as well. So this would be one, it has a spotty scorecard because of the cyclical nature of the business, but this is one that if the company does follow through with this growth, you could have some nice returns going forward. It offers a 2.4% dividend yield, BBB plus rated, 24% debt to capital. So here's the Hartford. The next company I'm going to take a look at is a real estate development company, not a REIT now, but a real estate development company. This is more of a growth stock. They do pay a dividend, although the dividend is very meager, less than 1% a year. BBB plus rated, 17% debt to capital. I'm going to shorten this a little bit to get rid of this high valuation. If you look at how the price tracks earnings, it's quite profound here, but obviously when you get into a bad earnings period like we did in the Great Recession, there could be substantial losses. Their long-term record is quite good, 15%, well actually 16% total return, 15.8, roughly double what the market did over this same time frame, which goes back to December of 2002. But even though they offer such a low dividend yield, they've actually produced about as much income as the S&P 500 has over this time frame, or since they've paid a dividend, simply because of the growth of that dividend, not because their yield is high. Anyway, that's Jones LaSalle, a company in the real estate development sector. Next, I'm going to move into regional banks, and one of the more popular or prominent bank, especially in my market here in Florida, is State Street Corp. State Street is interesting in that it offers a 2.6% dividend yield. You can see the price has tracked earnings. You can see periods of undervaluation and significant periods of overvaluation, but you always see the price reverting to the mean. They did cut their dividend during coming through the Great Recession, but since that time, in the last 8 years or so, they've had a very nice dividend record. They've increased it by about 10 or 11% per year. The stock is significantly undervalued, offers really excellent returns going forward. If you look at it even at a normal multiple, you could be seeing some, substantial annualized rates of return over the next 2 or 3 years looking at State Street. Now, the next is a savings bank. I'm going to look at Synchrony Financial here, BBB minus rated company, 23 billion in market cap, 38 billion in total economic value. Since it's a savings bank, they don't really record debt because debt is their product, but it's a relatively new company. They started paying a dividend in 2016. They offer a 2.6% yield, and this is really all about the future. If you believe these forecasts to be anywhere near being reasonable, this company could offer some tremendous rates of return going forward, assuming these analysts are correct in what they expect this growth to be, and assuming that the company reverts back to a more normal, even 11 or 12 PE. Look in here, if they just went back to a 12 PE, your average rate of return over the next 3 to 5 years could be as much as 17%, almost 18%. So that's a very interesting company. My next research candidate is Weingarten Realty. It's a BBB rated REIT, 51% debt. I'm going to shorten the time frame here to kind of look at this company over the last, well, actually going back since 2011. You can see that the price has tracked their funds from operations. They've had a couple of weak years. The price is down. The dividend yield, though, has remained intact. They've actually increased their dividend. There is a forecast for a moderate cut in dividends in 2020, but that's still to be determined. Otherwise, looking at their historical numbers, they've raised their dividend by about 5% a year. The stock yields 5.6% and is trading at a very attractive 12.5 price to FFO. So this is a REIT that, looks attractive. Now, there are other REITs out there that I actually like better, but this met the criteria that I screened for this particular series of articles. So that's why it's the one that I chose to highlight in this article. And then last but not least, I'm going to look at finance, rental leasing. I'm going to look at Western Union. I'm looking at operating cash flows here. The company offers a 4.4% dividend yield, trades at less than 10 times operating cash flow. If I look at it from a standpoint of adjusted operating earnings, as I have with each of the other companies that I've looked at here, the valuation is currently very attractive. In fact, it normally trades at about a 12 PE. It's currently trading at a 9.5 blended PE, offers a 4.5% dividend yield. Once again, if I look at the forecasting, growth is to be mooted at around 3%. However, because the stock is so undervalued, there are double-digit rate of return potentials available in this stock, assuming it reverts back to its more normal multiple. I see no reason why it hasn't done that. It's had a reversion to the mean history here that's been quite consistent. Anyway, this is a look at some of the value that's available in the finance sector. Again, I want to reemphasize that a lot of these companies trade at a discount to the orange line here, which would be a theoretical fair value for companies with similar fundamentals. But financials tend to be traded at a discount, although I did show you some exceptions. I hope you enjoyed this article. I look forward to talking to you again. This is the 14 subsectors of the finance sector. It's been Chuck Carnival saying thanks for watching.